Everyone knows common stock is like what people talk about. You see it on CNBC, you see the stocks going up and down. When they're talking about the market, they're talking about common stock. But a lot of people on the exams and in general don't know what preferred is. It's like a little weird cousin that's like half bond, half stock. It's still equity, and it pays a steady income, but there are some trade-offs that you lose. You don't have certain things that bonds have, and you don't have certain things that common stock has. So let's get into it. So first of all, preferred stock is an equity. It's still stock. It's not a debt. It acts like a hybrid between a stock and a bond. It pays fixed dividends, not interest. Usually they pay quarterly, but they could pay monthly. Stockholders rank ahead of common, but behind bonds in liquidation. And they don't have voting rights. So let me explain that other thing part, making sure. See my dog's going nuts. Okay, so now, if a company goes bankrupt, or they're paying in general, it's not just bankruptcy. They pay secured bonds first, then unsecured, then any kind of bond is always ahead of this, then the preferred, then the common. So preferred is preferred because it gets paid before the common. But it doesn't have voting rights. It doesn't move up and down with the like when this company has good news, it doesn't go up and down. It sits there because it pays a fixed income. If it's a 4% preferred paying like $4 a year, right, out of 100, say, and the company has an incredible year, it still pays $4. It doesn't change. So it acts like a bond, even though it's stock. So think of it as like a steady income product. Now, who's going to buy preferred stocks? Well, it's good for conservative investors who want income and are okay with giving up growth. It's bad for investors looking for capital appreciation or growth. They're going to buy common stock because it doesn't move that much. It's boring. It's like a bond. Institutions like insurance companies and pension funds love it because of the tax breaks. So it's very cool. Anytime you buy, if a corporation, not us schlubs, but anytime a corporation buys common or preferred and they get a dividend, they only pay tax on half the dividend. So that's a thing that even in real life, it's good to know, but on the test, it's going to be there. If an institution or corporation buys common or preferred, they only pay tax on half the dividend. So if you have a choice of a 5% bond and a 5% preferred as an institution, the preferred's the better choice, tax-wise. Maybe not risk-wise, but tax-wise. So again, you buy preferreds for income, not growth, not really at all. And I'm going to talk about the different types of preferred. There are a lot of like hybrid ones and stuff, but we're going to talk about the main ones. So remember something, it's a dividend. We don't have to pay you. It's like, oh, we're supposed to pay you, but we don't actually have to pay you. It's just like a dividend. The board of directors decides every quarter whether they're going to pay you or not. But they will most likely pay because if they don't, that's the only reason you're buying the goddamn preferred anyway. So if they don't pay, screw it, I'll just sell it and they'll never be able to issue another one. So preferreds don't have to pay, but they're usually going to. What happens if they don't? Well, there's not much you can do. You just, hey, you rattle your swords, you get mad at them. Unlike a bond where you can sue them, this is like, oh, I'm just pissed off at you. So they made a couple different types, one called cumulative preferred. So they have cumulative and non-cumulative. Non-cumulative means if they miss the dividend, you're out of luck, you're not going to get it back. Cumulative means that even if they miss a dividend, even for years, they will eventually, if they ever want to pay the common a dividend, have to pay all the back dividends that they missed, even if it's years ago. Cumulative has to pay back the old one. Non-cumulative, you're screwed. It doesn't matter. So cumulative will have a lower coupon or yield because it's better for you. Anytime somebody offers something better for the customer or the investor, they're going to pay less. So remember, cumulative means we pay the back dividends. Non-cumulative means you're out of luck. Then another one I like is called participating. Well, remember I said it pays a fixed dividend no matter what, no matter how good we do? Well, we can create a participating one where you get to participate in the earnings growth. So if the company has a great quarter earning, that dividend will go up that time. They'll bump it up and maybe 1 or 2% or 3%, whatever it is, they will give you a little bonus for that quarter. Not permanently, and if we keep beating it, it keeps going up. But it's always going to go back to its base. So participating means you get to participate in the upward earnings. They have a good year, you'll get a little bonus. Then we have my favorite, convertible. Convertible means you can turn it into common stock at a price anytime you want. So that's good remember, it turns into the common of the company. So it's going to move with the common stock too because it turns into it. So you have growth potential at the same time as getting fixed income. It's a best of both worlds with that one. So it's like fixed income, plus you get growth potential because at any time you can turn it into common. So it will move with the common stock. And then we have the last one, callable. There's callable and not callable, right? Callable means that if the interest rates drop, the issuer goes, I don't really want to pay that high rate anymore, so they're going to buy it back from you at a set price. So if rates drop, issuers call it back. So that's what callable is. And you're like, oh, I'm getting a big return. And then the company takes the money back. So they have another one called non-callable, they can't call it back from you. And that's better for you, so the rate is lower. So again, callable, they can buy it back. Non-callable is better for you in general, so they're going to pay you less. What are some of the risks of preferred stock? Well, if rates go up, your bonds, your preferred still, I call it a bond, your preferred is still paying the same amount, but the new ones are paying more, so it's less attractive, the price drops. Interest rate risk, when rates go up, the price of your bond or your preferred drops. You have inflation risk. Remember, you're getting the same amount of money every single time, but prices of goods keep going up and your money is losing purchasing power, so it's worth less. That's inflation risk. Credit risk, they don't really have it. It's just if they don't pay it. I call it business risk, because if they stop paying the dividend, you're kind of screwed. Then we're back to call risk, because when rates drop, the issuer is going to go, I don't want to pay that high rate anymore. So they're going to call back your preferred, pay it off, and issue preferreds at a lower rate and save some money. Kind of like refinancing a loan. So remember this, preferred stock is steady income, priority over common, but limited growth. On the exam, know the types: cumulative, convertible, participating, callable, and who it's good for. Income-focused conservative investors, no growth. Think of it as a middle ground, safe, but not too risky. If you want to crush the SIE of the 7, keep drilling these differences until they're second nature. Get them in there. And don't forget to meet me every Tuesday night on the Tube Review, 8 p.m. Eastern, for a live Q&A. Free shit. It's a real shit show. We have a lot of fun. Let's fucking go.